Hello, this is Bruce Wan, Head of Research for MaxCap Group. In this video today, I want to talk about the outlook for the construction sector over the next year. Specifically, where are we with the cost inflation outlook? What does it mean for building profitability? What is the outlook for builder financial distress? And finally, what are the implications for lenders and credit providers in this space? Certainly, looking back, it has been a challenging number of years for the construction sector. In 2021, the disruptive impacts from COVID lockdowns and supply chain breakdowns lifted building material costs by more than 30%, giving us the biggest inflation spike since the global oil price shock of the 1970s. In 2022, central banks in Australia and other parts of the world embarked on an aggressive run of interest rate hikes to combat this runaway inflation, driving the sharpest increase in borrowing costs in more than 40 years. Altogether, these factors have been quite detrimental to the construction sector, pushing a lot of building projects into the red, into financial loss, and pushing more builders with weaker balance sheets into insolvency. In 2024, we are seeing more signs of a turnaround in the construction sector as more of these adverse profit drivers start to unwind. On the cost inflation front, we're well past the peak for this cycle. Looking at this chart, we can see the trends in consumer price and building cost inflation over the past 50 years, with the most recent inflation peaks in 2022 before a clear and steady moderation since then. Consumer price inflation is easing back slowly, but we are not expected to dip below the official inflation ceiling of 3% until 2025, thereby holding interest rates higher for longer. The sharp slowing in construction cost inflation is particularly interesting. As more inputs like fuel, steel, and timber report falling prices, these things are contributing to a broader trend for cost disinflation, much like what we've seen in every disinflation cycle over the past 5 decades. This turning point in cost inflation is providing more breathing room for the construction sector. Industry profits are on the rise again as builders move on from their loss-making projects of 2022 to relatively more profitable projects in 2024 and beyond. To be clear, the construction sector is not entirely out of the woods yet. Labour shortages are still affecting the sector, which prompt higher wages growth ahead. Interest rates are still elevated and not expected to fall until 2025, and even then, rates are not expected to fall by much, with just one rate cut priced in next year. Construction insolvency rates will likely come down slowly as builders gradually work through their legacy book of loss-making projects. For lending and credit providers, there's a lot of work to do ahead even as the outlook improves. Lenders need to keep a very sharp eye on builder performance, particularly on their cost management, and also on developers in terms of their progress towards sales targets and their capacity to service their loans on a timely basis. However, for all the challenges within the construction sector, credit returns have been exceptionally strong, well supported by the move to floating rate facilities and high interest rates. For some people, this resilience in returns is somewhat surprising, given all that we've seen in recent years, but it does reflect the full recourse, lender-friendly features of the Australian credit market that is working to the benefit of credit investors. If you are interested about the potential opportunities in this space, reach out and talk to our capital team. This has been Bruce Wan for MaxCap Group.